Welcome to the Dealmaking with Laura DiFrancesco podcast. I'm Laura DiFrancesco, your host. We're talking all about mergers and acquisitions, buying and selling small businesses, as well as corporate law. We are taking our experience closing over $10 billion of transactions since founding Dean Street Law 5 years ago, and my experience being an M&A and corporate attorney for over a decade and making it accessible to you as an entrepreneur. I hope that this helps you in navigating the complex world of mergers and acquisitions. And also, we're always happy to be a resource for you here at Dean Street Law. You can always apply to work with us through our complimentary consultations linked in our show notes. And a huge shout out and thank you to everyone who's subscribed and left us a 5-star review. If you haven't yet, be sure to subscribe and also leave us a 5-star review. It's one of the best ways to support us as a small business. And also be sure to share with your friends and colleagues on social media, through text, email, or however is easiest. It means the world to us that you're supporting our content and helps us make more to support you in your journey. Welcome back to another episode of the Dealmaking with Laura DiFrancesco podcast. I'm your host, Laura DiFrancesco, founder of Dean Street Law and author of my new book, Entrepreneurship Through Acquisition, A Legal Guide to Buying a Small Business. If you haven't checked it out already, it would mean the absolute world to me. You can check it out through the link in our show notes or deanstreetlaw.com/links to see the first chapter, download it. You can see where to buy it as well, get on the wait list, pre-order, and it would mean so much to me if you have an opportunity to leave a 5-star review. You can email it to etareview@lauradifrancesco.co, and I will send you a pre-LOI due diligence request list as a thank you. So huge thank you to all of you who have supported the book so far. And if you haven't checked it out yet, please do. We also have a prior episode on the podcast all about what you can expect in it, why I wrote it, all of the things. So I'm really excited, and thank you guys all for your support. Now, with today's episode, we are going to be talking about rollover equity, specifically in light of the recent SBA changes. Do we got it? We got it. Specifically in light of the new SBA changes effective in June 2025. And then we're also going to be talking about that from a buyer's and seller's perspective. So rollover equity, what is it? There are two fundamental aspects of rollover equity. A lot of people call it rollover equity, but it technically depends on whether the purchase is an asset purchase or a stock purchase. Where it's an asset purchase, it is rollover equity because the seller rolls their equity from the ownership of the prior company to the ownership of the new company that's buying the business. And then if it's a stock purchase, it's technically called retained equity because the seller retains their equity position in the holding company, and then the buyer is part owner as well. Now, with that said, there can be a lot of fancy machinations around governance structure, holdco structure, all of those fun things. But essentially, when we're talking about retained or rollover equity, we're talking about the seller holding a piece of the pie, holding a portion of the business post-closing. And that's generally a form of compensation of the purchase price. So there are benefits and repercussions and considerations for both the buyer and the seller. So just before we get into the SBA changes, let's talk about generally what are buyers and sellers thinking about for rollover or retained equity. So from a seller's perspective, one of the benefits that they're thinking about is that this gives me another bite at the apple, a second opportunity to exit at a higher valuation. So especially where the buyer and seller are really aligned on strategic plans for the business, you'll see, and you have a seller who doesn't just want to exit now, but really wants an investment that they already feel passionately about to grow. It gives them an opportunity to continue to grow their investment. Another pro for the sellers is that it tends to have better tax planning implications. And so you'll work with your attorney and your accountant together on the tax strategy for a rollover. In addition to that, also sellers have a very emotional, sentimental attachment to the business and may not want to fully sell the business. Now, from a legal regulatory perspective, sometimes seller rollover or seller retained equity is necessary because, especially with licensed businesses, if the license requires that the owner of the business has a certain license or something of that nature, which depends state by state as well as industry, and on a federal level also, we help you with all of those determinations. Sometimes there must be a specific license holder as the owner, especially with law firms, accounting firms, professional service firms, but also sometimes with electricians or contractors of certain natures. They have to have an owner that has the license, and the license is held by the owner instead of the company. And then the company is permitted to take action and do those services that are licensed as a result of the owner having the license. And so that's one example, but there are also situations where they may have requirements, let's say for a certain government contract, that an owner of the business is of a certain demographic. Maybe they have a certain amount of experience, or they, because of the certain government contract that they have, that they are women owned, minority owned, veteran owned, something like that. So there may be regulatory or contract reasons why it may be beneficial to have seller retained equity or seller rollover equity. And then from the buyer's perspective, there can be a number of pros as well. And those can be that it incentivizes the seller to shepherd the success of the business post-closing, and so gives them more comfort. In addition, it keeps the seller engaged post-closing as well. It can also be a source of financing of sorts. Of course, it's going to have that SBA implication now, but it could also be a source of financing of enabling the buyer to bring 70% or 80 or 90% of the purchase price to closing via their own financing, and then have the ability for the seller to chip in as well by retaining equity rather than doing a full buyout. So those are a couple of the pros. What are the cons? For a seller, it does put that part of the funds at risk. Instead of getting cash, you're getting equity in a business you no longer generally control. And then in addition to that, there are going to be implications from financing perspective and rules and regulations associated with that, particularly when we come to an SBA loan, which we'll cover momentarily. And overall, when there is a lack of control of the business, sometimes sellers don't quite realize how different it will be not owning the business. And so it can sometimes be challenging to be continuously involved in the business, but at the same time have a minority stake in the business, not necessarily have control. Now there are negotiations of terms of voting rights and control and everything like that that can be negotiated, but as a general course, the seller would have a minority interest and lack of control over the business. From a buyer's perspective, it does have implications of financing, particularly with the SBA, and also it involves having someone else in your ownership table, in your cap table, that will inevitably have opinions. And just because there isn't control doesn't mean that there isn't influence. So that's important consideration as well. I really only recommend rollover equity or retained equity in situations where the parties are really aligned post-closing. It's been easy to get the deal done. It feels like there's a lot of synergy and trust developed. Most of the time with seller retained equity or rollover equity, it's people who have known each other for longer than the duration of just getting the deal done. Not to say that that's the only case, but generally you are looking at something that requires a lot more trust and cooperation moving forward, especially if it's something that's elected rather than required. Now, with that said, let's talk about the SBA requirements. So the new SBA requirements as of June 2025 have required that with respect to seller rollover equity, that the seller, no matter the percentage, even if it's under 20%, is also a personal guarantor of the SBA loan. That is obviously something that has been extremely challenging to navigate because most sellers would not want to personally guarantee a loan. If it is under 20%, they've capped it at 2 years. If it is more than 20%, it's a full personal guarantee. However, that has really, really stalled and limited the amount of seller rollover equity or retained equity that you'll see in lower middle market transactions. With that said, SBA is just one lender, one type of loan, right? There are tons of other ways to finance transactions, whether it be through equity, seller financing, or through other lenders' conventional loans. So it has not necessarily fully impeded the use of seller rollover equity or retained equity, but it has dramatically impacted it. When it comes to navigating corporate law, entrepreneurship, and managing small businesses, experience matters. Dean Street Law is a boutique corporate firm specializing in mergers and acquisitions, and additional focus in real estate, commercial transactions, finance, and corporate governance. With over $10 billion in deals closed, Dean Street Law has extensive experience representing hundreds of clients in thousands of transactions, from small businesses to Fortune 500 companies. Whether you need startup guidance or advice on closing multi-million or multi-billion-dollar deals, we're your trusted partner every step of the way. Visit deanstreetlaw.com in the show notes to schedule a complimentary consultation. So, let's chat a little bit about structure and deal terms in addition to all of this. So the most common negotiated term that most people include in the LOI is going to be the allocation of the purchase price that is considered the seller rollover equity. And when you're valuing the business, you generally have a fairly easy way to get to this of you have the value of the business, they're retaining or rolling over 10%. 10% of the purchase price is the value. Now, that's not always the case. It can be considerably more complex or different. You can always agree to whatever you agree to, but generally that's the case. So that's going to be number one thing that you see. And how much of the purchase price is generally rolled over is going to be highly dependent on a number of factors, which are the seller's desire to be involve and have an equity investment post-closing. That can be one of the biggest determinants. Another can also be the amount of involvement the seller expects to have post-closing. Now, that'll also have another SBA wrinkle in that in the SBA, a seller can only be involved for up to 12 months post-closing. Now, if you have them as an owner, of course, it's a bit of a different involvement. With that said, though, if the seller has no day-to-day involvement, the likelihood that they're going to want a 30-40% chunk of the pie still is probably less common than if they would want a 10 to 15%. So 10 to 15% is generally what you see in seller rollover equity in these types of deals, because most sellers are taking a big step back from the company. But there are some strategic acquisitions where that's not the case, and they're actually planning to be involved, but it's more of a collaboration, and they're really trusting the strategic acquirer to take the business to the next level, and they're staying involved, but they feel like they don't necessarily have the capabilities or tools to take the business to the next level. So it depends on the expectation of seller involvement. Now, whether it's a rollover, like I said, in terms of an asset purchase, or retained equity in terms of a stock purchase, will also determine in part how it's structured. So if it's a corporation, it's going to be stock. If it's an LLC, it's going to be membership interests. And then there are in stock different classes of stock. You could have preferred stock or common stock. And then in a LLC, you can have separate classes of LLC interests, but it's less common. Now, how those are structured into whether it is common stock, preferred stock, all the rights is highly, highly customized from deal to deal. I will say what is common is that it's treated equally as the buyer's interest. So it's considered pari passu on the same terms as the buyer's interests. So that's not always the case, but that is oftentimes the case. Typically, other investors in the deal might have different preferences or payout rights, and then the buyer and the seller may have other rights, but it's so dependent from deal to deal. In fewer situations, but sometimes it happens, you'll see it more in private equity or situations where there's an earnout or something like that. There may be vesting, and typically that's going to essentially build the seller up beyond the existing purchase price. So let's say there is a rollover equity of the amount equal to the portion of the purchase price, but then they have the ability to vest and gain more equity in the buyer's company if they meet certain metrics, whether that be EBITDA or revenue or something like that, or maybe they stay milestone based, they stay with the company for 3 years or more than 3 years. So those are some milestones, performance-based milestones that you may see in terms of vesting. But again, that's typically a additional add-on beyond the purchase price equivalent that you'll see. The next common term that you see is a lockup period. A lockup period is when the seller is prevented from selling their portion of the equity without the buyer's consent for a certain period of time post-closing. Generally, that's going to be 1 to 3 years. We see that more on the longer side of things. Now, there's also, in addition to that lockup period, there's also potentially drag-along rights, tag-along rights. So drag-along rights are the majority owner's right to force the seller to sell if they decide to sell the business. Tag-along rights are the minority equity holders' right to join the sale of a business if the majority interest decides to sell. So those may be negotiated in the organizational documents. The most important thing to know, I would say, is that this is going to be, the LOI is going to be the tip of the iceberg of what's included and what this is going to entail. And then the transaction documents, and particularly governance documents of the entity post-closing, are going to really determine the nuances of the details of the type of equity, the rights, the vesting, the lockup period, drag-along rights, tag-along rights, buy-sell provisions. There may be certain guaranteed exits, there may not be. And then there's a lot of other aspects as well that will be negotiated in those, such as voting, control, whether there are board seats. Typically, because it is a minority interest, there typically isn't board seats, but there may be voting rights, even if it's just 10%, the right to attend meetings, to be heard, to make statements before a vote is made. Those are all important rights. And then overall, this can be a great opportunity to align interests of the buyer and seller. So it's not something super pro buyer, super pro seller. It's really dependent on the preferences of the parties and the terms that they'll agree to. It's a great opportunity to align interests if that's an opportunity. It is something that requires a whole lot more trust and building a business together. It will enable the buyer to retain the leadership and experience of the seller if that's of interest. And for the seller, gives them the opportunity to benefit from the future success of the business, have potential tax benefits, and potentially also negotiate better deal terms. All depends. This is one mechanism with all of the deal terms overall that are going to be negotiated. So I hope that that's been helpful in recapping, one, the recent regulation changes or guidance changes with the SBA, but also how to think of this from the buyer's perspective and the seller's perspective. If this was helpful, please be sure to share on social media, tag us, and let others know that we're a great resource. If you'd like to work with us, we'd love to hear from you. You can always schedule a consultation call. And if you have not already, please be sure to check out my book, Entrepreneurship Through Acquisition, a legal guide to buying a small business. Your support means the world to me, and I would love to hear what topic you'd like to learn about next. Cheers and happy deal making. Thank you so much for joining us on this episode of the Dealmaking with Laura DiFrancesco podcast. I hope you found today's discussion insightful and that it brought you one step closer to mastering the art of mergers and acquisitions. If you enjoyed this episode, please be sure to follow and subscribe to Dealmaking with Laura DiFrancesco on your favorite podcast platform so you never miss an episode. And if you found value in our discussion, please leave a 5-star review. It would mean the world to us. And share this podcast with your network, friends, and colleagues. For more in-depth resources, be sure to visit our website, deanstreetlaw.com, where you can find articles, guides, and more information on our services. Don't forget to follow us on social media for the latest episodes, updates, tips, and exclusive content. You can find us on LinkedIn, Search Funder, at LM DiFrancesco on X, and at Dean Street Law on Instagram. Join us on our next episode where we'll explore more deal-making insights. Cheers and happy deal making.